Keeping a strict control over financial leverage, operating in a regulated space and being in the business of an essential services, the ongoing coronavirus threat has mostly kept IndiGrid, a listed InvIT, largely unaffected. In our Ideas for Profit today, I will discuss whether investors must keep their focus on this one. Let's first try and understand the nature of an InvIT. Well, InvITs are more of like a debt instrument. An InvIT will typically offer an interest or dividend or both out of the cash flows generated from the assets it is holding. Now, they are designed to protect capital and yet offer slightly better than a pure debt instrument as well. IndiGrid earns annuity or rental kind of an income from its large portfolio of power transmission assets, which are used by power companies and others to transport power from the point of generation to the end user. Now, the company has consistently declared a dividend of 3 rupees per unit quarterly, which adds up to an annual dividend payment of close to 12 rupees per unit. Now, at current trading price of these units at 94.7 rupees, the yield works out to close to 12.7%. These assets are regulated by the government and cash flows are backed by contractual obligations. Now, what is interesting is that the rating agencies such as CRISIL and ICRA have rated its instruments at AAA rating, which is at par with the rating of government securities as well. Now, IndiGrid over the years has also built a strong portfolio of transmission assets. While IndiGrid is largely insulated from the crisis caused by COVID-19, some minor impact on cash flows front could also emerge going forward. Now, transmission assets operate on an availability-based business model, where customers are billed on the basis of the availability of the assets rather than the actual flow of the power, which essentially means that even if the demand in certain sections of the market drop due to lower economic activity, the company does not lose business that way. Second of all, there could be fear about the delay in billing. For the Q4 FY20, the company has also recovered 108% of its revenue. However, it is possible that in the coming months, particularly for the months of say April and May 2020, the billing or payments could get delayed. Now, as a measure of relief, the government has also provided a waiver on late payment and charges and also interest. Now, the other important point is that the company has enough liquidity of close to 300 crore rupees, which is expected to provide some cushion during the times of delay in payments and billing. Now, the company's net debt to AUM or assets under management is quite low at 49%. During Q3 FY20, the company also earned an EBITDA of 314 crores, which was good enough to cover or more than 3 times its quarterly net interest expense of 107 crore rupees. Now, the reason why we like this stock at this point in time is that the calculated yield has increased recently because of the marginal correction in the unit prices, which we believe is a good opportunity for someone looking for a fixed income instrument and yet is looking to make slightly better returns than a debt instrument.